Hello and welcome to Switzer TV. I'm Peter Switzer. Thanks for joining me. And on tonight's program, we have Jun Bei Liu of Tribeca Alpha Plus talking about the three stocks that she really likes for this year. And I also ask her what she thinks will happen to the stock market over the course of 2023. Is it all the way up, or will there be a few downs before up becomes the main trend? And then I talk to Marcus Bogdan of Blackmore Capital about the income plays in his fund that he's actually focusing on right now. Which ones will be the good performers? Which ones are consistent performers when it comes to income? And that's the show. So let's kick off now with Jun Bei Liu of Tribeca Alpha Plus. Thanks for joining us, Jun Bei Liu.
Thank you for having me, Peter.
Jun, I'd like to talk to you about, a lot of people are asking me about, some people are really worried about this year because they're hearing the words recession all the time in the press. How do you respond to those kinds of negative headlines, and how does it influence the way you invest?
Yeah, absolutely. So, so to the first question, how do you react to this? Recession is now being predicted for a global market like the US and Europe, and for Australia, it's kind of a slowdown instead of recession. Investors tend to get really worried about it, but actually remember, share market is always forward-looking. So share market will look forward to what's going to happen in the next 12 to 18 months. So, that's why last year we had a bit of, volatility in the Australian share market early part of the year. Is all because everyone's worried about this recession that might take place sometimes this year. So, and then as we move through this period, you will actually see the share price started to pick up as the investors look forward to the recovery year. So, so recession not necessarily is going to be a bad thing for share price. Now, what's going to be a little bit difficult to get your hands on is really to get a sense of where the company earning downgrades will be. Share price already pricing in a slowdown in the Australian economy. You need the earnings then to be rebased to a more realistic level. Then, believe it or not, you could actually have a bull market right in the middle of the slowdown or recession in other markets.
So, when you're looking at the stocks that are likely to do better, the sectors that are likely to do better over 2023, will they be the same ones for all of 2023, or will there be like a rotation? Some sectors will do well in the first half maybe, and in the second half, when interest rate rises are over in the US and possibly over in Australia, will that lead to a rotation into other sectors?
Absolutely. So first half of the year, you certainly is going to see a bit more defensive sectors to do well. Things like healthcare, defensive growth, quality leaders will do very, very well because these companies will continue to deliver, double-digit growth. That they will have strong balance sheet, and their earnings not going to be impacted by slowdown here in Australia or globally. But however, these are going to do really well. But the second half of the year, it's likely we will move into a more bullish market. And then the second half of the year is sort of environment where you will see a lot of, they call it cyclical sectors, such as consumer, such as builders. A lot of those sectors that tend to get impacted by recession or slowdown, they will be the first mover. They will move very rapidly in terms of share price as the investors look forward to the following 12 to 18 months and thinking, earnings surely is can't get any worse. So, so these sectors, you will see them on the move and in the second half of the year. So it will be a clear rotation, more defensive first half, and then more cyclical recovery in the second half.
Yeah. And do you think tech companies are going to do better in the second half rather than the first?
Look, it depends on which part of the tech. I do think net overall this year, tech companies will do quite well because the valuation crunch that took place last year is pretty much done. And the interest rate expectations, if anything, is actually on the way down in terms of, where the expectation is. So what that means is that, tech company, if they can deliver growth, they will do pretty well. They might do better in the first half of the year. Second half, maybe use a bit of funding, but for some tech companies such as Zero, which has lagged this entire rally, is going to do a whole lot better, when the market moved towards the lagger, wanting to buy things that hasn't rallied as hard. So Zero, is very likely to see a very strong performance second half of the year.
It's interesting you should say that, because I was watching US business TV recently, and they were predicting that Intuit, which of course is Zero's biggest competitor in the US, they also were expected to have a good year as well.
Yeah, that's right. So, the share price was crunched at both of these companies because people worry about economic outlook for for these two businesses in UK because of slowdown economic activity. But their earnings still actually was just recovering from the COVID related lockdown and now moving into slowdown. But remember, these are both, or particularly Zero, is a growth company. It is still taking shares, still have very small market share over there. So if anything, it should see actually continued strong growth throughout the year.
Okay, so let's just now drill down to the three stocks that you have the most confidence in that they will do well over the course of 2023. Not to say that if you say them today, they're going to be great tomorrow or in 3 weeks' time, but over the course of this year. And let me give you an example. When the coronavirus hit, and I always use this for my own investment strategy, I love to buy quality companies that are smashed up by the market. And the easiest one for me during the coronavirus was the CBA at $58. Because I thought, well, even if it takes a couple of years to get back to 100, $58 was a very good buy of a quality company. So what are the kinds of companies that you think right now look really well priced for this year and even maybe 2024?
Absolutely. So there's a couple of winners that we will continue to hold. A couple of the, Treasury Wine is one that we have backed for a very long time, even though the share price has rallied, but there's a lot more. The company is not particularly expensive for, growing between 20-25%. And it's leveraged to the China reopening story. Tariff is, if the tariff gets reduced, for Australian wine into China, that's an added bonus. So, you get immediate earnings upgrade. The next one is Ramsay. Share price hasn't really gone anywhere. We believe that earning doubling in the next few years, or next 12 months, and also growing significantly over the next 3 years compounded, with earning recovering from the from the COVID impact. We think it's very well priced. It's very deep value sort of investment, and then the share price should see quite a meaningful sort of recovery. And that company's earnings clearly, same as Treasury Wine, is not going to be impacted by weather, recession, and all of that around in the US and in Australia. And then the next one is a little bit cyclical. That's the Zero that we talked to. We do think it is going through a little bit of volatile period because of the sentiment is so low in terms of businesses that have earnings or business have exposure to UK. We think Zero is an incredible growth story. You don't buy it for next year's earning. You really buy it for the 5 years earnings. So, our view of the next 12 months, Zero will pick up towards the end of the year, and it will become a strong performer.
All three companies have overseas earnings. Is there some kind of belief that when companies are good enough to compete on the world stage, they are companies worth investing in?
Yeah, absolutely. Look, not many companies have made it. It's incredibly difficult to replicate their business model, Australian business model, into other countries. Many have failed, but for those that have proven their ability to do so, things like CSL, like Cochlear, like ResMed, it really expand their addressable market incredibly large. And Australia is a small country. Eventually, you run out of the population to sell your products to, and there's only so much lever you can pull in terms of prices. If you can actually grow into other countries and show that you could do it, it just opens up so much possibility. That is a company you do want to have sort of in your portfolio as a structural winner.
Bumped into the chairman of IDP Education during the week, and I know it's a company that you like, but you know, the market has caught up with its great performance. But is there any more upside for IDP Education, do you think?
Yeah, absolutely. I'd hold on to the IDP if you still have it. This company is, essentially earning almost evaporated when student disappeared. But now the student number into Australia is looking very strong. And this is even before China reopened their border. And then as you can see, Chinese used to be 30% or close to 40% of the student numbers. And now the Chinese government is urging all the students to go back offshore to study. So you will see this additional wave of students coming through. It's almost like travel. There's a bit of a pent-up demand happening, and it will take multi-years for that pipeline to wash through. IDP is looking at earnings upgrade for the next 2 years. I definitely hold on to it.
Yes.
Thank you very much.
And that was Jun Bei Liu of Tribeca Alpha Plus. Before we go to our next guest, let me remind you, after February, this program will go behind the paywall. You'll be able to access it by becoming a subscriber to the Switzer Report. The Switzer Report gives you a whole lot of valuable ways, valuable insights to make money in investing in the stock market and also in the bond market as well. It's $397 a year or $35 a month, and it entitles you to a newsletter delivered to your inbox 3 times a week, access to all our live events, access to our Boom, Doom and Zoom show on Thursday, which is a webinar where you can either type in questions or actually go live and ask questions. And it's a chance for you to actually ask experts about the stocks that you either are in or you want to be in. So please consider it. It's the Switzer Report. Go to switzerreport.com.au and I hope you become a subscriber. Now, let's go and talk to Marcus Bogdan of Blackmore Capital. Well, joining me now is Marcus Bogdan of the Switzer Dividend Growth Fund in Blackmore Capital. And I'm keen to see how he sees income coming from companies playing out in 2023. Good to see you, mate.
Good to see you, Peter. Happy New Year to you.
Same to you. Great start to the investing year. Not many people would have predicted it, but it's really great to see. And we know there's been capital growth on the stock market. Have a lot of the dividend stocks that you have in your portfolio, have they benefited from this upswing in the market?
So the rally has been broad, and so the portfolio has moved ahead. But the rally has been most pronounced in those companies that really underperformed in 2022. So areas of such as technology, the miners, and deep cyclicals have recovered incredibly sharply for the month of January. The more staple stocks, which were the strong performers of last year's, companies like Spark New Zealand, Brambles, and Amcor, far more defensive in their characteristics, haven't had the same uplift as those types of more sort of high octane type of stocks. But we do believe that they're better placed as the year proceeds because we do expect the economy to continue to slow.
Has a company or two that wasn't on your radar screen last year getting on your radar screen?
There are several stocks on our watch list, but the strength and the movement in some of these stocks has been very, very pronounced. And we don't want to chase those stocks. We have sort of a firm valuation around them. So our preference is that we would prefer to be more patient and wait for better entry points. And we fully expect to see that in the coming months.
You know, the reporting season's on now, and after that we start hearing, or during it we start hearing about the dividends. What's your expectation for dividends for this half of the reporting season?
Well, importantly, we do expect dividends to grow this year, not at the rates that we've seen in the last couple of years where we've had earnings growth and dividend growth in double digits. This year, we expect far more modest growth in corporate profits, and that will relate to more modest growth in dividends, but still certainly positive. And we still think that the banks can grow their dividends. We think the miners can grow their dividends. And they're two really important ballasts in the income portfolio in terms of providing good dividend growth. I think the second element, which is worth considering, is that the dividend yield on the Australian share market is still above the cash rate. And we're one of the few equity markets that is still the case. In the US, the cash rate is now above what the average dividend yield is on the S&P 500. But in Australia, you're still getting that positive carry on dividends in Australia.
Has there been a company that you've held in the portfolio that you've actually increased your exposure to because you're anticipating either capital growth or a better dividend?
Well, we haven't actually added or sold anything in the portfolio for this new year. But late last year, we did add to companies such as BHP at much lower levels. And we thought that there would be ultimately a recovery there in resources, particularly in iron ore. That is certainly been the case. And then companies that fell out of favour at the end of last year, companies like Medibank, we took advantage of the 20% fall in their share price after the cybersecurity incident. We believe that the underlying business is very sound and the dividend yield is attractive. And so they're the types of things where we want to be patient, wait till things have been sold off and buy things with a higher degree of a margin of safety.
What, on your reckoning, is the company that is the most consistent and reliable when it comes to dividends?
Well, I think it's hard to go past companies like Commonwealth Bank. I mean, since their listing in the early 1990s, they have consistently provided very good dividends for investors. There have been times when they've had to reduce that, but that's very much the exception. And that's been reflected in a very strong share price in CBA. And more recently, it's been the miners because they've been so disciplined around capital and capital expenditure, coupled with higher commodity prices, that companies like BHP have actually been one of the more attractive dividend providers in the Australian share market.
Yeah. So if you look at the likelihood of a slowdown in the Australian economy, does that necessarily translate to lower dividends?
Not in the actual quantum of lower dividends, but a lower growth rate in the growth of the actual dividends. And so where we've seen double-digit growth in dividends in subsequent years, we expect that those dividends will grow in 2023, but at a much sort of lower level.
CBA, and clearly with its current elevated share price, the dividend yield would be lower as a consequence. It'll still be reasonably attractive, I presume. But what about the other banks? Have you got other banks in your portfolio which actually do generate a higher dividend yield because the entry price is a lot lower?
Yes, and CBA is certainly the highest quality bank that we own, and that's reflected in the premium that it trades to the market. We also own National Australia Bank and Westpac, so we own 3 out of the 4 major retail banks. And you're absolutely right; those dividend yields are higher, and we do expect that those dividends will grow in 2023.
Interest rates still on the rise. That does help the bank's bottom line, doesn't it?
Certainly in the short term. I mean, there's lots to sort of drive the composition of the net interest margin, but at the moment they are a beneficiary of higher interest rates and beneficiaries of that spread that they can get between their loan and deposit rates.
Over the course of this year, Marcus, is there a sector that's been out of favour that you suspect will come into favour, and as a consequence you'll be eyeing off quality plays that may well also be good for dividends?
So one of the areas that did underperform, particularly last year and into this year, has been healthcare. Now, healthcare in many respects was deeply affected with what happened in COVID. And a lot of elective surgery and general medical screening has been postponed. And there's great shortages in the healthcare system in terms of servicing patients. But ultimately, we do believe that those levels of activity will need to be serviced and they will go back to long-term trend rates. And so healthcare is one area which has underperformed the market, but we do firmly believe that will be a good contributor over the medium to longer term.
Healthcare stocks for their dividend or for their potential growth?
Primarily for their potential growth, but we certainly want to receive a dividend as we wait for that growth to re-emerge. And as that growth re-emerges, we do see a good recovery in the underlying dividend as well. So it's two parts. It's the dividend yield, the level of the dividends are paid to investors, coupled with the growth of the dividends over time as well.
If you weren't holding CSL in your portfolio, and I know you do, but is there another healthcare stock you hold?
Yes, we do. We hold Ramsay Healthcare, which was under a takeover bid late last year, and we do expect private health hospitals to recover given the significance of the backlog. And then some of the other service providers such as Integral Diagnostics and Helios, which has got exposure to both pathology and to radiology.
I was actually given a question today on Integral Diagnostics on our Boom, Doom and Zoom show for our Switzer report subscribers. And tell us about the company.
So Integral Diagnostics is purely a diagnostic, a radiology group. It's an amalgam of a range of different practices. It's the fourth largest radiology group in Australia, and also they've got a presence in New Zealand. And so their levels of activity are very much linked to a recovery in elective surgery and general healthcare screening. So those numbers have been very compressed over the last year or so, but we are now starting to see those growth rates returning back to normal. And coupled with some acquisitions there, we do expect that company can grow at the high single-digit levels over the forecast period.
What do they pay?
So the dividend is sort of 2 to 3%, but we do expect that's on compressed earnings. We do expect that dividend will improve as the earnings recover. Okay,
mate. Well, great to talk to you again. Our first interview for the year, but I'm sure we'll see each other a few more times before 2023 ends. Good to see you, mate.
Thank you very much, Peter. Cheers.
And that's the show for this week. Thanks for joining us. Remember, the program does go behind the paywall at the end of this month, so please consider becoming a subscriber to the Switzer Report. $397 a year or $35 a month. Thanks for joining us. See you on Monday.